So, you know how sometimes big, scary events happen, like the 2008 financial crisis, and we get the headline version of why. But there's often a much deeper, more intricate story underneath.
Absolutely. Way more going on below the surface.
Today, we're going way beyond the headlines and diving deep into something that might sound a bit dry, global trade and capital flow imbalances, to really understand if they were, the hidden engine driving that crisis.
It's a really crucial question.
If you've ever wanted to truly grasp the nuts and bolts of how the global economy works and what can make it go sideways, then stick with us.
It's fascinating, isn't it? Even after all the investigations and analysis following 2008, the fundamental plumbing, you could say, of the international financial system,
Yeah, the plumbing.
especially how money or goods flow between countries, often remains murky, really murky.
Hmm.
And without a clear picture of that plumbing, well, it's easy to misdiagnose what actually caused the problems.
Exactly. Think of this deep dive as your personal guide to unlocking these complexities. We're going to be spending our time with the ideas of Michael Pettis, particularly from his book, The Great Rebalancing.
A really insightful book.
Our aim is to dissect these issues in detail, way beyond the usual explanations you might hear.
And putting it in perspective, what Pettis argues is that the 2008 crisis wasn't just a bolt from the blue.
Right. Not random.
It was the result of these significant imbalances in how countries were trading and investing with each other, imbalances that had been building up over many years.
Okay.
Understanding that long-term buildup is absolutely key to understanding the eventual blow-up.
And it's not just a recent development, is it? It turns out economists have been thinking about these kinds of global imbalances for a long, long time.
Oh, yeah, for centuries, really.
Pettis actually draws some really interesting parallels to the theories of guys like Hobson and Conant, who, way back in the late 19th and early 20th centuries,
Hobson and Conant.
they linked this idea of needing to get rid of extra savings to the push for imperialism and the need to find foreign markets to sell to.
Right. Exporting capital, needing markets.
It might sound like ancient history, but the underlying logic about how imbalances work could still be relevant today.
That raises a crucial question. Can we really see echoes of those older theories in our modern, highly interconnected world?
That's what I was wondering.
Nail Ferguson's point that 19th century imperialism relied heavily on sending capital abroad. That definitely resonates with Conant's observation around 1900 that industrialized nations needed to export their surplus savings.
It suggests a persistent dynamic then.
It really does. A persistent dynamic in global economics.
Now here's where it gets really interesting for me. Back in Hobson and Conant's time, the countries with these excess savings were mostly the big industrial powers, right?
Yeah, the UK, France, Germany.
But if you look at the world today, the picture is much more complicated. We've got wealthy countries like Germany and Japan, but also poorer countries like China, all acting as major sources of these excess savings that need to go somewhere else.
That's a huge shift.
Okay.
Kenneth Austin's 2011 analysis does a great job of highlighting this significant change in who the major players are.
Okay.
While the fundamental pressure to export surplus savings might still be at play, the global economic landscape and the actors involved have changed quite a bit.
And that brings us to Hobson's concept, often summarized as the economic taproot of imperialism. His basic idea was that these powerful industrial nations had this pool of excess savings.
Right, more savings than they could productively invest at home.
And the only way to deal with it was to find places to invest it abroad, which in turn required them to sell more goods overseas to earn the foreign currency needed for those investments. So it's like two sides of the same coin. You get rid of the extra stuff you're producing at home by selling it abroad, net exports, and that also helps you channel your extra savings into foreign investments.
Exactly. The underlying logic is that exporting capital and importing demand are fundamentally linked. A country that saves more than it invests domestically will inevitably see that excess capital flow out of the country as net foreign investment,
Right.
which manifests in the trade figures as a current account surplus, more exports than imports. It's an accounting identity, really.
Now, the way countries actually accumulate these foreign assets has also changed quite a bit since the age of imperialism. We don't see as much direct colonial control.
No, thankfully.
Instead, a big driver now is the accumulation of foreign currency reserves by central banks. Think about why a country does that.
Yeah.
It's to try and keep their own currency stable,
Yes, stability is key.
to have funds to pay back any debts they owe in other currencies, and crucially, to make sure they can still afford to buy essential goods from abroad if they hit a period of financial stress.
Which happens, especially in developing economies. Those reserves are a buffer.
While some people use the term mercantilism, the idea of trying to export more than you import to build up national wealth, to describe the policies of countries like China, Japan, Korea, and Germany.
You hear that term thrown around?
Pettis argues that it doesn't fully explain everything.
Right. He thinks it's a bit too simplistic. While accumulating reserves makes perfect sense for developing countries that have a history of volatile economies, it doesn't quite explain why very rich countries also do it, or why some poorer countries like China have accumulated reserves far, far beyond what seems necessary for basic stability.
Okay, so there's more to it than just wanting a safety net.
Pettis points to distortions in domestic monetary policy caused by this excessive reserve accumulation as a key factor. It actually messes with their own internal monetary settings.
Okay, let's break that down. So it's not just about these countries wanting to be top dog and selling stuff. There's a deeper game involving managing their own savings and investments.
Precisely. While the desire to boost exports is certainly a factor in many countries' policies, Pettis argues that the fundamental driver behind large trade surpluses is often the way a country manages its domestic savings relative to its domestic investment.
Oh, okay.
If policies create a situation where a country is saving significantly more than it's investing at home, the inevitable result will be a net outflow of capital and a current account surplus. It just has to balance out that way.
Now, another classic argument for governments getting involved in trade is the infant industry idea, which Alexander Hamilton, one of America's founding fathers, championed way back in 1791.
Right, Hamilton's Report on Manufactures, a foundational text.
His logic was that new American industries needed to be protected from more established European competition through things like tariffs. This would give them time to grow, become efficient, and eventually compete on their own.
Yeah, temporary shield.
Once they were strong enough, the protection could be removed.
Hamilton's argument was remarkably insightful for its time. He recognized that developing a manufacturing base had significant positive knock-on effects, externalities, we'd call them now, for the entire economy.
Right.
Even though those benefits weren't always reflected in the profits of individual companies. He saw this as crucial for the long-term prosperity and independence of the United States.
But Pettis argues that this infant industry idea doesn't really hold up as a good explanation for the big global imbalances we see today.
Clearly, no.
I mean, countries like Germany and Japan aren't exactly infant industries. They're technological powerhouses.
Hardly infants, exactly.
And in China's case, while they've definitely used protectionist measures, it could be argued that this actually hinders the kind of domestic competition that's needed for real long-term innovation.
That's a key critique.
Yep.
It might create strong state-backed companies, sure, but not necessarily ones that are truly driven to be globally competitive without that protection. It can stifle internal dynamism.
What's really striking is that the basic economic principles that govern the global balance of payments are actually quite well understood by economists.
The fundamentals aren't really in dispute among serious economists.
The real challenge isn't a lack of theoretical knowledge. Instead, it's consistently applying these fundamental principles to the very complex and interconnected web of policies and institutions that shape how countries trade and invest with each other.
Exactly. We need to think about the entire global system and how all the pieces fit together, rather than just looking at individual countries or specific policies in isolation. It's about the system dynamics.
So it's not just about putting tariffs on things or tinkering with your currency's value.
No, it goes much deeper.
Pettis makes the point that a whole range of seemingly unrelated domestic policies, things like industrial subsidies, tax laws, and financial regulations, can actually have a really big impact on a country's trade balance by shifting that fundamental relationship between how much a country consumes and how much it produces its GDP.
Absolutely. These seemingly domestic policies can indirectly lead to significant distortions in international trade. For instance, a government policy that offers big tax breaks for companies to invest in new factories, while at the same time keeping taxes on households relatively high, could lead to a situation where the country as a whole is saving more and consuming less, which would likely result in a larger trade surplus. It changes the savings investment balance.
And these trade balances aren't happening in their own little bubble, are they? They're all tangled up with how much countries are saving, how much they're investing, and how capital flows across international borders.
Completely tangled.
If one country's trade balance changes, it's going to send ripples through the savings and investment rates both at home and in other countries, and that automatically affects how money moves around the world.
This interconnectedness is a crucial point to grasp. A policy decision in one nation can have unintended and significant consequences for savings and investment patterns in another. And importantly, a country's national savings rate isn't something that governments can just decree and expect to change overnight. It's deeply rooted in these underlying policies.
So you can't just tell people to save more or less.
Not effectively, no. Trying to force a change in the trade balance without addressing those fundamental drivers of savings and investment is likely to lead to messy and disruptive adjustments in international trade. Disorderly adjustments, as Pettis calls them.
Pettis has structured the Great Rebalancing to really tackle these areas of confusion, hasn't he?
Yes, it's very systematic.
He starts by looking at the general principles of trade intervention, then he dives into China as a really important real-world example of these imbalances.
A crucial case study.
And finally, he tackles the often misunderstood role of the U.S. dollar in the global financial system.
That's right. The structure of the book mirrors the key areas where misunderstandings about global imbalances tend to arise. By systematically examining each of these areas, Pettis aims to provide a much clearer and more coherent understanding of how the global economy actually works.
Now, before we get any deeper into the specifics of how trade intervention works, Pettis emphasizes the importance of remembering some fundamental accounting identities in economics.
Yes, the boring but essential stuff.
Because, as he stresses, these are not just theories, they are mathematical truths that always hold.
They have to hold. These identities provide the essential framework for understanding how different parts of the international economy hit together. They are the non-negotiable rules of the game.
First up, Pettis reminds us that a country's current account surplus, which is basically the difference between its exports and its imports, when exports are greater.
Exports minus imports of goods and services,
Right.
plus net income from abroad.
Right. That surplus is always and exactly equal to the amount by which its total domestic savings exceeds its total domestic investment.
Savings minus investment, SI, always.
So if a country is saving more money than it's investing within its own borders, that extra saved money has to go somewhere, and it ends up being invested abroad, which shows up in the trade figures as more exports than imports.
Precisely. The excess savings get exported as capital.
And conversely, as Pettis points out, if a country has a current account deficit, meaning it's importing more than it's exporting, this always means that it is investing more domestically than it is saving, and therefore it needs to borrow or otherwise attract capital from abroad to fund that gap between investment and savings.
The investment is greater than savings.
Right.
So it needs to import capital.
Okay. And what about a dollar that a U.S. company earns from selling something overseas? Where does that dollar end up?
Exactly.
Yeah.
That dollar has only 3 possible destinations, as Pettis clearly lays out. First, it could be used to purchase goods or services from another country.
Imports.
Second, it could be used to make a payment to someone abroad, like paying interest on a loan.
Okay.
Or third, it could be saved by using it to purchase a U.S. asset, like a bond or a piece of real estate, effectively flowing back in. There are no other options for that dollar. It has to leave the hands of the exporter and flow out of the country or back in, either through what we call the current account, trade in goods and services,
Right.
income, or the capital account, trade in financial assets. So the total flow of dollars into and out of a country must always balance out to zero.
Got it. Always balances. And if a country's total domestic savings are higher than its total domestic investment, that excess saving has to leave the country as an outflow of capital.
Yes.
And here's a really key point that Pettis emphasizes. By exporting that capital, the country is essentially importing demand from other countries in the form of that current account surplus, more exports.
That's the crucial link. Exporting capital, importing demand.
So in essence, exporting capital and importing demand are really just two different ways of looking at the same underlying economic reality.
This is a point that Pettis stresses repeatedly throughout his work because it is so fundamental to understanding global imbalances, and yet is so often overlooked or misunderstood in public and even policy discussions. A net outflow of financial capital from a country necessarily implies a net outflow of goods and services from that country, a trade surplus, and vice versa.
Yeah.
You can't have one without the other in the long run.
And finally, Pettis reminds us of another core identity, a country's gross domestic product, or GDP, the total value of everything it produces within its borders,
Total production.
has to be either consumed by its residents or saved for the future.
Consumption plus savings.
Mhm.
C plus S.
Even things that might seem like waste, like unsold goods sitting in a warehouse, are technically counted as part of investment, which is a form of saving in this context.
Right, inventory investment counts.
Yeah.
So national savings is simply calculated by taking the total GDP and subtracting all of that total consumption, GDP C equals S. This seemingly simple accounting identity is absolutely fundamental, as Pettis highlights. It underscores the fact that any government policies or other economic forces that significantly affect either the total production of a country or the total level of consumption within that country will have a direct and unavoidable impact on the country's overall savings rate.
So everything is linked.
This relationship is at the heart of understanding how trade imbalances arise.
Now, in our modern, deeply interconnected global world, these savings and investment rates of individual countries aren't just determined by what's happening within their own borders, are they? It's not like each country's economy is an island.
Not at all. While domestic government policies and the decisions of individuals and businesses within a country certainly played a role in shaping its savings and investment rates, in a globalized world, the policies of foreign governments, acting through their impact on the trade account, exports and imports, also exert a significant influence on a country's savings and investment patterns.
So when we hear people simplistically praising the supposed thriftiness of a country like Germany, which often runs large trade surpluses,
The hardworking Germans.
and criticizing the supposed spendthrift ways of a country like Spain, which has often run trade deficits,
The lazy Southerners.
yeah,
It's such a damaging stereotype.
they might be completely missing the bigger picture of what's actually driving those imbalances.
Precisely. As Pettis argues, it's entirely plausible, and in many cases likely, that the savings rates observed in both Germany and Spain were more a direct result of the specific government policies enacted in each of those countries.
Policy choices.
Policies that influence the fundamental relationship between investment opportunities and the incentives to save, rather than being primarily driven by some inherent cultural differences in the population's desire to save or consume.
And what about the very common idea that China's massive and persistent trade surplus is simply a result of deeply ingrained Confucian values of thrift and hard work in its population?
Pettis strongly challenges this rather simplistic cultural explanation. He points out the historical irony that the very same Confucian culture was, just a few decades ago, often blamed for Asia's widespread poverty.
Really? Blamed?
Yes, with commentators suggesting that it fostered laziness and a lack of the kind of thrift needed for economic development.
Wow.
This dramatic and complete reversal in the perceived economic impact of Confucian culture over a relatively short period strongly suggests that culture alone cannot be a stable or sufficient explanation for complex and shifting economic trends like national savings rates and trade balances.
It's quite striking, isn't it, how a seemingly fundamental cultural trait can be seen as a major barrier to economic growth at one point in history, and then suddenly be hailed as the key to an economic miracle just a few decades later.
It really underscores the crucial importance of digging beneath these easy, often superficial cultural attributions and actually understanding the underlying economic mechanisms and policy choices that are truly driving economic outcomes like trade surpluses and deficits.
And it seems that this human tendency to look for simple, often culturally based explanations for complex financial events is nothing new in history.
Oh, definitely not.
Pettis notes that periods of significant financial crisis have always been followed by a flood of analysis attempting to understand what went wrong and assign blame.
The recent global financial crisis is certainly no exception to this historical pattern. The intense search for understanding, for assigning causes and finding explanations, is a very natural human response to such large-scale and impactful events.
But the way we actually discuss and analyze economics has changed quite a bit over time, hasn't it?
Yeah, the platforms have changed.
Pettis makes an interesting point about the rise of economic blogs in the internet age, seeing them as a modern-day equivalent of the pamphlets and intense discussions that used to happen in coffee houses back in the 19th century.
It's a good analogy.
It's become a much more open and accessible way of debating these often complex issues, reaching a much wider audience than the sometimes narrow focus of specialized academic journals.
This significant surge in more public and less specialized writing and discussion about economics has, in Pettis's view, been a genuinely positive development for the field as a whole.
You think so?
He believes it fosters more creative and out-of-the-box thinking about economic problems and leads to a greater overall understanding of how economic forces play out in the real world beyond the confines of purely theoretical models. It democratizes the debate, in a way.
Okay, so we've established that these global trade imbalances were a really key factor in the lead up to the 2008 financial crisis, and that these imbalances are driven by a complex interplay of factors that go way beyond just simple trade policies or ingrained cultural habits.
Right. It's systemic.
Now, let's get down to the more specific details. According to Pettis, how exactly does trade intervention when governments try to influence the flow of goods and services across their borders actually work?
Okay, this is a crucial part of Pettis' argument, and it's where he challenges some very common assumptions about how trade policies impact the economy. Well, it's certainly true that things like tariffs, taxes on imports, and currency devaluation, making your currency cheaper relative to others, are forms of trade intervention.
The obvious ones.
Pettis argues that their primary impact on a country's trade balance doesn't come directly from making foreign goods more expensive or domestic goods cheaper in a straightforward price comparison.
Oh, how then?
Instead, he contends that these policies work more indirectly by significantly affecting a country's overall savings rate relative to its investment rate. It's back to S minus I.
So when we hear arguments, and we hear them quite often from business lobbies and sometimes even from policymakers, that putting tariffs on goods from a country like China, for example, won't really affect the overall U.S. trade balance because the U.S. doesn't even produce those specific kinds of goods anyway.
Yeah, the we don't make that stuff here argument.
According to Pettis, that's not the complete picture.
That particular argument, as Pettis succinctly puts it, is unlikely or impossible in its premise. Even in a hypothetical situation where a country, he uses the example of a fictional place called Fredonia that imports all of its widgets and produces none domestically.
Fredonia and its widgets, classic example.
Doesn't produce any of the goods it imports. Imposing tariffs on those imports will still have a significant impact on its trade balance.
Okay, walk us through this Fredonia example. They import all their widgets, then the Fredonian government slaps a tariff on all imported widgets. What happens in their economy?
The immediate effect of the tariff is that the cost of those imported widgets goes up for households in Fredonia who want to buy them.
Makes sense.
This effectively reduces the real purchasing power of their income. They have to spend more of their money to buy the same number of widgets. Even if Fredonian households continue to buy the exact same quantity of imported widgets after the tariff is imposed.
Which might happen if there are no alternatives.
Yeah. They now have less of their income available to spend on other goods and services. This forces them to reduce their overall consumption of other things.
Okay, so the widget spending stays the same, but other spending falls.
Right. And this reduction in overall consumption by the households in Fredonia, that's where the change in the national savings rate comes in.
Yes.
Exactly.
Right.
Because the total income of Fredonian households hasn't changed, at least not directly or immediately, due to the tariff on imported goods they don't produce domestically. But their total spending on consumption has gone down due to the higher cost of widgets and their need to cut back on other things.
Right.
The overall national savings rate in Fredonia automatically goes up. If there isn't a corresponding increase in domestic investment within Fredonia, perhaps the government just collects the revenue from the tariffs and uses it to buy foreign bonds, for example.
Okay.
Then Fredonia's overall trade deficit, the amount it imports minus the amount it exports, will automatically shrink, even if the actual physical volume of widget imports remains exactly the same as before the tariff was introduced.
Wow. So it's not necessarily about the people of Fredonia suddenly deciding to become more frugal and save more of their income out of some newfound personal preference.
No, not about culture or psychology here.
It's the tariff policy itself that forces up the national savings rate by squeezing household budgets and leading to a reduction in their overall consumption of goods and services.
That's the key mechanism that Pettis highlights, and it underscores a really fundamental point in international economics. A trade deficit, by its very definition, means that a country's total level of investment within its borders must be greater than its total level of domestic savings.
IS again.
This gap between investment and savings has to be financed by an inflow of capital from abroad. Conversely, policies that increase domestic savings relative to investment will tend to reduce the need for foreign capital and can lead to a smaller trade deficit or even a trade surplus. It's all about that SI balance.
And what about when a country engages in currency manipulation, like deliberately devaluing its own currency to make it cheaper relative to other currencies? How does that action affect its trade balance, according to Pettis?
Currency devaluation, according to Pettis' analysis, is essentially a mechanism for transferring economic resources from those who are net importers in the economy,
Who's that usually?
which in most countries primarily means households who consume imported goods to those who are net exporters, which is typically the sector of the economy that produces tradable goods, goods that can be easily exported and compete internationally.
Okay. A transfer from households to exporters.
By making the domestic currency cheaper in relation to foreign currencies, the country's exports become relatively less expensive for buyers in other countries, which tends to boost production and sales in the domestic tradable goods sector.
And what's the impact on the other side of the equation, on consumption within the devaluing country?
On the other side, currency devaluation tends to reduce consumption within the devaluing country by lowering the purchasing power of disposable household income.
Because imports cost more now.
Exactly. Imports become more expensive for domestic consumers.
Yeah.
So with the devaluation, you typically see an increase in domestic production of tradable goods and a decrease in the consumption of imported goods, and potentially some domestically produced goods as well due to the overall squeeze on household budgets.
So production up, consumption down.
Which means this combination automatically leads to an increase in the national savings rate of the devaluing country. Again, Pettis emphasizes that this isn't necessarily about a sudden shift in people's inherent desire to save more, but rather a direct consequence of the currency adjustment and its impact on the relative prices of goods and services.
Now, you mentioned a potential silver lining for households in a country that devalues its currency, using Greece as a cautionary example. Can you elaborate on that a little bit?
Right, the potential benefit of devaluation for households really hinges on the state of employment in the economy. If a country is suffering from high levels of unemployment and stagnant economic growth,
Which many countries facing devaluation are.
a currency devaluation can provide a significant boost to production in the tradable goods sector as their products become more competitive internationally, potentially leading to the creation of new jobs. As more people find employment, the aggregate real household income in the country can actually rise.
Oh, interesting.
If this aggregate increase in income is large enough, it could potentially outweigh the individual losses in purchasing power that households experience due to the higher cost of imports.
So the total pie grows enough to offset the smaller individual slice.
Potentially. In such a scenario, you might see an overall increase in consumption, but typically the increase in production will be larger, leading to a faster increase in overall national savings and a contraction of the trade deficit.
But the Greece example.
Right, cautionary tale. As we saw in the case of Greece, which was part of the Eurozone and couldn't independently devalue, and which also had a very large amount of external debt denominated in euros.
A huge problem.
A hypothetical devaluation would have made that debt much, much more expensive to service,
Yeah.
creating a whole new set of problems. So the benefits are not guaranteed and depend heavily on the specific circumstances of the country, especially its debt situation.
So the primary purpose of trade intervention, whether it takes the form of tariffs on imported goods or deliberately devaluing the national currency, isn't just about making your country's goods relatively cheaper and foreign goods relatively more expensive in a direct price comparison.
Oh, that's the surface effect.
It's fundamentally about trying to increase domestic employment by capturing more demand from foreign consumers, and in the process of doing that, it automatically leads to a rise in the national savings rate of the intervening country, according to Pettis.
Precisely. And this increase in the national savings rate occurs irrespective of any underlying cultural predispositions of the population to save or consume. The policy itself alters the economic incentives and constraints that shape those decisions.
This understanding really helps to clarify a point of confusion that I've often encountered in discussions about international trade. The argument that if a currency like the Chinese renminbi were to revalue upwards, become more expensive relative to other currencies,
Let the RMB appreciate.
it wouldn't actually have much of an impact on China's very large trade surplus because they produce goods so cheaply that the rest of the world will continue to buy them in the same quantities regardless of a slight price increase.
That particular argument, as Pettis states quite directly and unequivocally, is almost total nonsense.
Aha, okay, pretty clear then.
The only highly improbable scenario in which it could potentially hold true is if the Chinese government's level of intervention in the currency market was completely and utterly unaffected by the prevailing price level, which is an extremely unlikely assumption. If that were indeed the case, then the Chinese authorities would have absolutely no reason not to revalue the renminbi immediately and significantly to improve their country's terms of trade, the ratio of export prices to import prices, without suffering any negative consequences for domestic employment.
They'd get more stuff for their stuff, basically.
Exactly. The fact that they haven't done so suggests that they clearly understand that currency valuation does indeed have significant economic effects.
And what about the various conspiracy theories that often circulate regarding China's massive holdings of U.S. government debt? Some people argue that if China were to suddenly stop buying U.S. treasuries or, even more dramatically, start selling off its existing
The
holdings,
financial weapon idea.
it would somehow cripple the U.S. economy or give China enormous political and economic leverage over the United States. How does Pettis view these claims?
Pettis dismisses these kinds of concerns as confused to the point of nonsense, and even as violating basic arithmetic principles.
Strong words again.
He points out that a dollar owed by the U.S. government is still worth exactly $1, regardless of who happens to be holding that debt or what the prevailing exchange rate between the dollar and other currencies might be.
A dollar is a dollar.
However, he notes that these persistent misconceptions do unfortunately highlight a widespread lack of understanding about the fundamental role of central bank foreign exchange reserves and how they relate to a country's overall trade balance.
Mm.
People don't grasp why those reserves build up.
So if China were to significantly revalue the renminbi upwards, what would be the likely overall impact on the Chinese economy itself, according to Pettis?
Generally speaking, Pettit argues that a significant upward revaluation of the renminbi would likely be beneficial for China in the long run.
Beneficial. How so?
After a revaluation, China would essentially be able to exchange its exports for a greater quantity of imports than before its terms of trade would improve. The value of what it sells abroad would increase relative to the value of what it buys from other countries.
So better purchasing power internationally.
Exactly. While some might argue that China, as a significant net creditor in U.S. dollars, due to its large holdings of U.S. dollar-denominated assets like treasury bonds, would suffer a loss in value in renminbi terms if the dollar weakened against the renminbi.
The value of their stash goes down on paper.
Pettis contends that even this view is often incorrect and requires a careful distinction between what he calls a real economic loss and a purely accounting or realized loss.
Can you explain that distinction between a real loss and a realized loss in the context of a currency revaluation? Let's say the renminbi is revalued upwards by 10% against the US dollar. What happens to China's holdings of US dollar reserves when you express them in renminbi terms?
Okay, so in purely renminbi terms, the nominal value of China's U.S. dollar-denominated reserves would indeed decrease.
Right, fewer RMB per dollar.
If the renminbi strengthens by 10%, then each dollar held by the People's Bank of China would now be worth 10% fewer renminbi on their balance sheet. However, the crucial point that Pettis emphasizes is what China can actually do with those foreign exchange reserves.
What they're used for.
By their very nature, these reserves can only be used to pay for foreign imports of goods and services, or to repay foreign currency-denominated obligations. They cannot be directly spent within the domestic Chinese economy.
Can't spend dollars easily in Beijing.
Therefore, while the renminbi value of the reserves on the central bank's balance sheet might decline, the renminbi cost of those future foreign payments that China needs to make would also decrease by exactly the same proportion.
Ah, so the cost of imports goes down in RMB terms too.
Precisely. In terms of the real purchasing power for international transactions, there is no additional loss incurred due to the revaluation. It's a change in the accounting value, but not necessarily a loss in the ability to conduct international trade and payments.
That's a really key distinction. Now let's shift our focus to China's famously high national savings rate. One very common explanation that's often given for this is the relatively weak social safety net in China.
Yes, you hear this all the time.
The argument is that because Chinese households have less confidence in government support for things like healthcare, education, and retirement, they are forced to save a much larger portion of their income as a precautionary measure to cover these potential future expenses.
This is indeed a very widely cited explanation, and it's often supported by commentary from various experts, including the quote from Tang Jun in the Washington Post that you mentioned in the outline. The perceived lack of a dependable government safety net undoubtedly creates a strong incentive for Chinese households to save for these essential needs.
But Pettis offers an alternative or perhaps a more fundamental perspective on why China's savings rate is so high. While he doesn't dismiss the importance of the weak social safety net,
He doesn't ignore it, but
he argues that its primary impact on the savings rate might not be solely due to the immediate need for those precautionary savings.
his argument is that the relatively weak social safety net that exists in China today is, in part, a consequence of the significant erosion of Chinese household wealth that occurred during the country's transition towards a more market-oriented economy.
How so?
In the past, under the more centrally planned system, state-owned work units provided many of these essential social services, things like healthcare, housing, education, and even retirement benefits. The Iron Rice Bowl.
Right, the state took care of things.
When these work unit-based benefits were significantly reduced or eliminated during the economic liberalization, it effectively transferred a very substantial set of future liabilities, the responsibility for funding healthcare, education, and retirement from the government and state-owned enterprises directly to individual households.
Okay, so households suddenly had these huge future costs dumped on them.
Exactly. This represents a significant reduction in the net wealth of the household sector relative to the overall national production of the economy. To compensate for this increased burden of future expenses, Chinese households were compelled to consume a smaller proportion of their current income, thus forcing up the overall national savings rate. It wasn't just precautionary saving, it was a response to a huge wealth transfer.
So, if the Chinese government were to significantly improve the social safety net, say, by providing much more comprehensive and reliable healthcare, education, and retirement benefits, would that automatically lead to a substantial decrease in the Chinese national savings rate?
Not necessarily, at least not in the direct and straightforward way that many people might expect.
Oh, why not?
If the improved social safety net is primarily funded by additional transfers from the household sector to the government, for example, through higher taxes or increased government borrowing that is expected to be repaid by future taxpayers, who are also households,
So, if households pay for it one way or another,
then the net impact on overall household disposable income, and therefore on national savings, could be relatively small. In fact, in the short term, it might even lead to a temporary reduction in consumption if households perceive their lower current disposable income from paying for the benefits before they fully trust in the long-term value and reliability of those future benefits provided by the state.
trust is a big factor there.
Absolutely. The key is whether the perceived net wealth of households increases significantly as a result of the improved safety net after accounting for how it is financed.
Okay, so it's clear that trade intervention isn't just about the obvious tools like tariffs and currency adjustments.
Much broader than that.
Pettis makes a strong case that a much broader range of seemingly unrelated government policies can have really significant impacts on a country's overall trade balance by affecting that fundamental relationship between national savings and national investment.
Absolutely. The definition of what constitutes trade intervention needs to be much wider than just those policies that are explicitly labeled as trade-related. Anything that has a significant and systematic effect on the gap between a nation's total savings and its total investment can have important consequences for its international trade and capital flows.
He uses the example of environmental degradation in poorer countries as a more subtle form of implicit trade subsidy. How does that particular issue play into the global picture of trade imbalances?
Right. The argument here is that when poorer countries have much weaker environmental regulations and enforcement compared to richer countries, it can act as a kind of hidden or implicit subsidy to their local manufacturers.
Because they don't have to pay the full cost of pollution.
Exactly. Because they don't have to spend as much on pollution control or waste disposal, their production costs can be lower than those of competitors in countries with stricter environmental standards. This lower cost structure can then give them a competitive advantage in international markets, effectively subsidizing their exports and potentially undermining the tradable goods sectors in countries with higher environmental standards.
You hear unions complain about this.
Yes, trade unions in the United States, for example, often raise concerns about this issue, arguing that it creates an uneven playing field. It externalizes costs.
But the impact of environmental degradation isn't just through this cost advantage for producers, is it? Pettis suggests there's a more complex effect on the overall trade balance.
That's right. The impact on a country's trade balance from weak environmental standards is more multifaceted than just lower production costs. Environmental degradation can also lead to a reduction in the overall wealth and well-being of households within the affected country due to health problems and the deterioration of their natural environment. Think polluted air and water. This reduction in perceived and actual household wealth can, in turn, lead to lower levels of consumption as people become more concerned about their future and the costs associated with environmental damage.
So they save more because they're worried about health costs or a damaged future.
Exactly. A lower level of consumption, all else being equal, contributes to a higher national savings rate. So you have increased production in some sectors due to lower regulatory costs and potentially decreased consumption in the household sector due to the negative wealth effects of pollution.
Wow.
Both of these effects can contribute to a larger trade surplus for the country with weak environmental standards, even while its overall population might be getting poorer in terms of health and environmental quality.
That's a pretty counterintuitive and somewhat disturbing outcome. A country could end up with a larger trade surplus, even while its citizens are suffering from the negative consequences of environmental damage.
It shows how complex these relationships are.
Now, what about the role of local housing markets and stock markets? How can booms in these asset markets influence a country's trade balance?
Soaring asset markets, particularly in areas like housing and stocks, as we saw in the United States, and some peripheral European countries in the years leading up to the 2008 financial crisis,
The bubble years.
can create a significant surge in the perceived personal wealth of households. When people feel richer because the value of their houses or their stock portfolios has gone up considerably, they tend to increase their consumption out of their current income.
The wealth effect.
Precisely. They might feel more secure about their future financial situation and therefore be less inclined to save as much, relying instead on their increased asset values to cover future needs. This surge in consumption, fueled by perceived wealth from asset bubbles, can lead to lower national savings rates relative to GDP.
Okay.
As domestic demand rises due to this increased consumption, a country's imports tend to grow faster than its exports, potentially leading to an expansion of its trade deficit. People buy more imported goods when they feel rich.
So you can have this seemingly paradoxical situation where people feel like their personal savings are rising because the value of their house has gone up significantly.
My house is my piggy bank.
But at the same time, the actual national savings rate of the country as a whole is declining relative to its total economic output.
Exactly. It's crucial to distinguish between the perceived wealth of individual households, which might be increasing due to asset price inflation, and the actual flow of savings within the economy as a whole, relative to the country's total production. These can move in opposite directions, especially during periods of asset market booms and busts.
Pettis also touches on the impact of inflation as a potential form of wealth transfer within an economy. How does inflation typically affect the balance between different groups, and how might that relate to trade?
Inflation, which is a general increase in the price level of goods and services in an economy, typically results in a transfer of wealth from net lenders to net borrowers.
Lenders lose, borrowers win.
Generally, yes. Net lenders are often households who hold their savings in relatively fixed income assets, like bank deposits or bonds. Inflation erodes the real value of these savings over time.
Your cash is worth less.
On the other hand, net borrowers, such as governments that have issued long-term debt, large corporations that have the power to reprice their goods and services as prices rise, and speculators who have borrowed money often benefit from inflation because they can repay their debts with money that is worth less in real terms than when they originally borrowed it.
Okay.
The relationship between inflation-driven wealth transfers and the trade balance is complex and can depend on which sectors of the economy are most affected in terms of their propensity to save or consume. It's not always straightforward.
And what about the situation where wage growth in an economy consistently lags behind the growth in overall productivity? How much output is produced per worker? How does that kind of dynamic affect the savings rate and potentially the trade balance?
All right, this is a really important one. When wage growth lags behind productivity growth, it effectively acts as an implicit transfer of income from labor, workers, to capital, owners of businesses and shareholders.
So profits rise faster than wages.
Essentially, yes. A larger share of the economic output is accruing to companies and their owners, while workers' share remains relatively stagnant or grows more slowly. Since those with higher incomes, owners and shareholders, tend to save a larger proportion of their income than wage earners.
Rich people save more.
This shift in income distribution towards capital generally pushes up the overall national savings rate of the economy. Higher savings, without a corresponding increase in domestic investment, can then lead to an increase in exports relative to imports, potentially resulting in a larger trade surplus or smaller trade deficit.
Mm-hmm.
In a healthy, long-run equilibrium, wage growth should ideally match productivity growth to maintain a relatively constant share of the total economic pie going to workers, which in turn helps to keep the consumption share of GDP relatively stable.
But when that doesn't happen,
When this equilibrium is violated, it leads to a gradual transfer of the ownership share of the economy. In many developing countries undergoing rapid industrialization, you often see wage growth lagging behind productivity growth due to factors like large rural to urban migration flows, which keep downward pressure on wages. It boosts competitiveness but suppresses domestic demand.
Pettis also highlights some more specific and perhaps less obvious policy examples that can significantly impact trade balances. He discusses land acquisition policies in China, where local policymakers often take agricultural land for commercial development. How does that kind of policy action end up affecting China's trade position?
When local governments in China acquire agricultural land, often at prices well below market value, and then rezone it for commercial or industrial use, it represents a very significant transfer of wealth.
From who to who?
From the rural farmers who own the land to the state, to industrial companies that benefit from cheaper land for factories, and to wealthy individuals who can profit from real estate development.
Okay, farmers lose out.
This transfer of wealth has a direct impact on trade by reducing the overall wealth and future income prospects of the farming households. As a result, these households tend to reduce their consumption and increase their savings in an attempt to compensate for this loss of an asset base and future income.
They save more because they lost their main asset.
Exactly. This decrease in household consumption at a national level contributes to a higher overall national savings rate. At the same time, the increased availability of land for industrial purposes can spur greater investment and production in the manufacturing sector, further contributing to a potential trade surplus.
So it boosts production and suppresses consumption again.
Yes, the Wukong protests in Guangdong province, which gained international attention, are an example of the social unrest that can arise from these kinds of land acquisition policies.
And then there's the concept of financial repression that Pettis discusses as another often overlooked form of trade intervention. For those of us who aren't economic experts, what exactly is financial repression and how does it act as a tool that influences trade?
Financial repression refers to a set of government policies that are designed to artificially lower the interest rates that savers receive on their deposits and other savings.
So keeping interest rates low for savers.
Artificially low, yes. These policies effectively transfer wealth from savers, who receive lower returns than they would in a free market, to borrowers, who can access capital at artificially low costs.
How do they do that?
The primary mechanism through which this happens is that the government often imposes regulations on the financial system, such as interest rate ceilings on deposits or requirements for banks to hold large amounts of low-yielding government bonds. This effectively subsidizes the cost of capital for certain borrowers,
Like who?
which often include the government itself, infrastructure investors, large corporations, and real estate developers, leading to increased investment and potentially faster economic growth in those sectors.
So the people who are saving money in banks are getting a raw deal in terms of the interest they earn.
Yes, net depositors in the financial system, which are often households, are the ones who lose out under financial repression because they receive lower returns on their savings than they otherwise would.
And the borrowers win.
On the other hand, net borrowers, which frequently include the government, companies investing in infrastructure, corporations expanding their businesses, and real estate developers undertaking new projects, are the winners because they can borrow money at very low subsidized interest rates.
And the trade impact.
From the perspective of international trade, financial repression acts in a similar way to other consumption-repressing policies we've discussed. By artificially reducing the returns on household savings, it discourages consumption and encourages saving. At the same time, the lower cost of borrowing stimulates production and investment in certain sectors.
Same pattern. Repress consumption, spur production.
Exactly. This combination leads to a higher overall national savings rate and can contribute to a larger trade surplus as the country produces more than it consumes domestically.
Now, what about the common assumption that higher interest rates are a good thing for encouraging saving and reducing consumption? Pettis seems to offer a bit of a nuanced perspective on that relationship.
He does indeed. While the intuitive idea is that a higher reward for postponing consumption, i.e. higher interest rates on savings, should lead people to save more.
Standard textbook idea.
Pettis points out that the empirical evidence for this is not always as clear-cut as one might think. He uses the example of China, where real interest rates on bank deposits, the nominal interest rate minus inflation, have often been negative, yet the country still has an extraordinarily high savings rate.
Right, negative real rates, but massive savings. It's weird.
He also cites historical data from the United States, where periods of falling interest rates have sometimes coincided with rising savings rates, particularly during times of economic uncertainty and declining asset market values, like after a crash.
So if it's not just about the direct incentive of higher returns, what does Pettis suggest is a more significant driver of household decisions about saving and consumption?
Pettis argues that the wealth effect is likely a much more powerful driver of how much people choose to consume and save.
Back to the wealth effect.
Essentially, the wealth effect suggests that people tend to base their spending decisions not just on their current income, but also on their overall perception of their wealth. If people feel richer, perhaps because the value of their houses or their stock portfolios has increased significantly, they're likely to spend more and save less, even if their actual income hasn't changed much.
Feel richer, spend more.
Conversely, if they feel poorer due to falling asset prices, they might cut back on spending and save more.
Feel poorer, save more.
In the United States, there often appears to be a negative correlation between interest rates and overall household wealth. As interest rates fall, asset prices like housing, stocks, and bonds tend to rise.
Okay.
However, in financially repressed countries like China, where a large portion of household savings is held in bank deposits rather than directly in appreciating assets, this negative correlation might not be as strong, or it even might be reversed.
Ah, because their main asset doesn't boom when rates fall.
Exactly. Pettis shares an interesting anecdote about a Peking University student's aunt, who, when faced with lower interest rates on her bank deposits, actually felt compelled to save more out of her current income to reach a specific target amount she needed for her son's education, thus leading her to reduce her consumption. Low rates made her save harder.
That's counterintuitive. So, in essence, financial repression acts as a kind of hidden tax on households who are savers and an implicit subsidy to producers and borrowers, ultimately pushing up the overall national savings rate and potentially leading to a larger trade surplus, much like currency undervaluation and lagging wage growth, but through a different set of actors and mechanisms.
That's a very accurate summary. All of these policies, currency undervaluation, keeping wage growth below productivity growth, and financial repression, have the common effect of suppressing household consumption and boosting production or investment in other parts of the economy, which inevitably leads to a higher national savings rate.
And just to bring it full circle on this point, Pettis uses the example of Japan after the Plaza Accords in the mid-1980s to illustrate how a government might try to manage these competing forces.
Right. The Plaza Accord forced the yen up dramatically.
He explains that while Japan agreed to allow the value of the yen to rise significantly against the US dollar, which, all else equal, should have made their exports more expensive and imports cheaper.
Should have reduced their surplus.
The Japanese government simultaneously implemented policies of increased credit expansion and lower domestic interest rates. These latter policies had the effect of encouraging borrowing and potentially boosting domestic consumption, which could have partially or fully offset the expected impact of the stronger yen on Japan's trade balance.
They tried to counteract the yen's appreciation with easy money domestically. It really highlights how different policy levers can interact in complex and sometimes unexpected ways.
Okay, so after laying out these general principles of trade intervention and exploring the various forms it can take, Pettis then turns his attention to a very specific and highly relevant case study: China.
The elephant in the room, you could say.
He mentions an ongoing internal debate within China about the most effective path for rebalancing its economy away from its heavy reliance on exports and investment towards greater domestic consumption. This debate is often framed as a contrast between the Guangdong model and the Chongqing model. Can you give us a quick overview of what those two approaches represented?
Sure. The Guangdong model, generally associated with the coastal export powerhouse region, represented a more liberal, market-oriented approach to economic development. It emphasized greater openness to international trade and investment, and a smaller role for direct state intervention.
More market-driven.
In contrast, the Chongqing model, which gained prominence under the controversial figure Bo Xilai, advocated for a more state-controlled approach to development. It put a greater emphasis on social welfare programs, income redistribution, and a stronger role for state-owned enterprises, sort of a populist, state-led model.
Okay, two different visions.
The political clash between these two visions, symbolized in part by the eventual deposition of Bo Xilai in 2012, reflected a fundamental disagreement within the Chinese leadership about the future direction of the country's economic policies.
And this internal debate was taking place against the backdrop of a really dramatic decline in the share of household consumption within China's overall economy. By around 2005, it had reached an incredibly low point.
Yeah, incredibly low. By the mid-2000s, household consumption in China had fallen to around 40% of its gross domestic product, GDP.
40%, that sounds tiny.
It was an exceptionally low level by international standards for a major economy in modern history, with very few comparable examples. This dramatic decline in the share of the economy devoted to household spending was a significant concern for policymakers in Beijing, who repeatedly stated their intention to take measures to boost domestic consumption and achieve a more balanced growth model. They knew it was a problem.
And the inevitable flip side of that coin, a declining share of consumption, was, of course, a significant rise in savings within the Chinese economy, particularly in household savings.
That's correct. While household consumption as a percentage of GDP was falling, the rate at which Chinese households were saving their income was simultaneously increasing quite significantly. Estimates suggest that household savings rose from a range of maybe 10–20% of disposable income in the 1980s to around 26% or even higher in more recent years.
A huge jump in the savings rate.
A substantial increase, yes. And it's a critical component of the large macroeconomic imbalances that China had developed.
And as we've already discussed in some detail, Pettis argues that this soaring savings rate in China was not primarily driven by a sudden change in the cultural preferences of the Chinese people.
Not just Confucian thrift.
Instead, he attributes it to a combination of various government policies and structural factors, including the deliberately undervalued currency, the persistent lagging of wage growth behind rapid productivity gains, the effects of financial repression, the externalized costs of environmental degradation, and the weakening of the social safety net in the post-reform era.
It's that whole package of policies we talked about.
All of these policies and structural changes, whether intentionally or as a byproduct, had the effect of encouraging rapid investment and production in certain sectors of the economy, often at the expense of the household sector's income share and thus their ability to consume.
Exactly. Pettis argues that Beijing's growth strategy, while undeniably successful in generating rapid GDP and employment growth for several decades, essentially forced Chinese households to subsidize a high rate of investment and production. This was achieved through various mechanisms that constrained the growth of household income relative to the overall economic output, which in turn limited the growth of household consumption. The household share of the pie just kept shrinking.
But Pettis is keen to point out that China's chosen model of rapid investment-led growth is not entirely unique in economic history.
No, it has precedence.
He characterizes it as a kind of souped-up version of a broader Asian development model that was seen in countries like Japan in the 1960s. He also draws parallels to other historical periods of rapid industrialization, such as Germany in the 1930s, Brazil in the 1960s and 1970s, and even the Soviet Union in the 1950s and 1960s.
Right, the high investment, state-directed model. While these models often succeed in generating strong early growth, Pettis contends that they inherently lead to deep structural imbalances within the economy that create distortions.
The experience of the Brazilian miracle in the 1960s and 1970s provides a relevant example.
Yes, Brazil achieved very high rates of economic growth during this period through massive state-led investment in manufacturing and infrastructure, often funded by heavy income taxes imposed on households.
So households paid for the growth.
Pretty directly, yes. While the growth rates were impressive, this model also carried significant risks, including the potential for misallocation of subsidized investment and the accumulation of excessive debt. As Yasheng Huang has pointed out, these kinds of investment-driven miracles can sometimes mask underlying inefficiencies and even wealth destruction, building things that don't actually pay off.
And there are inherent limitations to this kind of heavily investment-driven growth model, aren't there? It can't just continue indefinitely.
Absolutely. History shows that these models eventually run into constraints. Two of the most common are debt financing constraints. A country can only borrow so much.
The debt wall.
And external account constraints. Persistent large trade deficits can become unsustainable, or, in China's case, managing the huge surpluses becomes problematic. Brazil famously hit the wall with its debt, leading to the lost decade after the limits of petrodollar recycling were reached. China's own experience, as well as the historical experiences of other countries that followed similar development paths, strongly suggests that this model has a natural lifespan.
Pettis also comes back to the idea of these hidden taxes,
Hmm.
the undervalued currency and financial repression, and how they create a wedge between overall GDP growth and the growth of household income.
Right, the gap between GDP growth and what people actually feel in their wallets.
He argues that these policies effectively subsidize employers and lower the cost of borrowing for businesses, which boosts their competitiveness and encourages investment, but they simultaneously constrain the growth of household income and therefore household consumption, which is a key driver of China's persistently high savings rate.
This divergence between rapid overall economic growth and much slower growth in household disposable income is a critical feature of China's development model and a key factor behind its large trade surpluses and high savings.
Pettis then brings in the economic historian Alexander Gerschenkron's concept of backwardness to help explain the initial stages of China's growth.
Gerschenkron's idea of the advantages of backwardness.
Gerschenkron argued that economies that are relatively less developed can sometimes generate faster rates of growth by deliberately constraining consumption in favor of investment,
Forcing savings into investment.
with state-directed banks playing a crucial role in allocating capital to key sectors due to perceived failures in the private sector's ability to identify and fund these crucial investments.
Gerschenkron's theory suggested that in less developed economies, the state could play a catalytic role in mobilizing capital and directing it towards investments that would generate positive spillovers for the wider economy, overcoming the limitations of nascent private capital markets.
But Pettis emphasizes that there are limits to backwardness. This state-led, investment-heavy model, even if initially successful, cannot be sustained indefinitely.
Correct. The inherent risks associated with relying heavily on debt-financed investment and the eventual constraints imposed by the external account, the need to balance international payments, ultimately limit the viability of this model in the long run. China's recent economic challenges seem to be a manifestation of these very limits. The model runs out of road.
And this brings us to the problem of overinvestment that Pettis highlights in the Chinese economy, both in massive infrastructure projects and in manufacturing capacity.
Yes, the potential for widespread malinvestment.
Talk about the infrastructure side first.
In the realm of infrastructure, the easy availability of financing, often with implicit state guarantees and socialized risk, coupled with artificially low interest rates, makes it very difficult to determine whether these investments are truly generating long-term economic value that exceeds their cost.
It's hard to tell if a high-speed rail line really pays for itself if the financing is super cheap and backed by the government.
Exactly. Pettis mentions the Commonwealth problem, where the benefits of a project might be highly localized, while the costs are spread across the entire population. Furthermore, due to China's lower overall level of worker productivity compared to richer nations, the same amount of infrastructure investment might generate less overall economic value.
And manufacturing.
In the manufacturing sector, the low cost of borrowing, again often subsidized through the financial system, can allow even factories that are not particularly efficient or competitive in a global market to show accounting profits,
Profits on paper.
essentially thanks to the implicit subsidies they receive from household depositors through financial repression. Pettis suggests that the state-owned sector in particular might be a significant source of this kind of value-destroying overinvestment, building capacity that the world doesn't actually need.
So, in an environment like this, where capital is cheap and readily available, it requires a tremendous amount of heroic restraint on the part of policymakers and businesses to avoid investing in projects that don't actually generate long-term economic value.
Heroic restraint is a good way to put it. It's very hard to say no to cheap money.
And historically, as Pettis points out, many countries that have followed similar growth models have fallen into this trap of overinvestment, including Germany, the Soviet Union, Brazil, and Japan at different points in their development.
Indeed. The temptation to simply invest more and more, especially when financing costs are artificially low, can be very strong, often leading to diminishing returns and ultimately to economic imbalances and crises.
Given all of these internal and external pressures and imbalances, Pettis anticipates a significant slowdown in China's economic growth rate in the coming years, perhaps even lower than the 6–7% that many mainstream economists are currently predicting.
His analysis of the underlying adjustment arithmetic suggests that the necessary rebalancing of the Chinese economy towards greater domestic consumption will likely necessitate a much more substantial slowdown in growth, potentially to around half of those optimistic projections, maybe 3–4% or even lower for a period.
Wow, that's a big adjustment. And the challenge of rebalancing China's economy towards greater reliance on domestic consumption is going to be absolutely enormous, given how extraordinarily low household consumption as a share of GDP currently is in China.
It's huge. With household consumption making up only around 34–35% of China's total GDP, there is virtually no precedent in modern economic history for a major economy to have such a large domestic imbalance and then successfully and quickly reverse it. The scale of the required shift is truly unprecedented.
The fact that banks in China have enjoyed easy access to financing has certainly boosted their profit margins and made it easier to deal with non-performing loans.
Kicking the can down the road on bad debt.
But as Pettis points out, this has come at the continued cost of household depositors who receive very low yields on their savings.
Yes, this ongoing financial repression continues to facilitate the transfer of resources from the household sector to the state and other borrowers, thereby perpetuating the suppression of household consumption. Savers keep paying the price.
So, for China to truly rebalance its economy in a meaningful and sustainable way, there needs to be a fundamental reversal of this decades-long trend of a shrinking household share of the overall GDP.
The direction has to change.
Resources need to be systematically transferred back from the state and other sectors to the household sector to boost their income and their ability to consume.
Pettis suggests two primary ways this could potentially happen. The good way, in his view, would involve some form of direct or indirect privatization of state-owned assets, with the proceeds used to recapitalize the banking system and potentially provide direct benefits to households. Basically, give households ownership of state assets.
That sounds politically difficult.
Extremely. Less good, but perhaps politically more palatable way, would be for the state to directly absorb the existing bad debts in the financial system, as Japan did in the aftermath of its own asset bubble burst in the 1990s.
The government takes the hit.
Yes. But as Japan's subsequent experience has demonstrated, this approach can lead to a massive increase in government debt, which then becomes a significant drag on future economic growth and the ability to undertake further reforms. Japan's lost decades are a stark warning.
Okay, now let's turn our attention to the other side of the imbalances. Pettis makes a really important point that a country's savings rate isn't determined in isolation.
Right, it's a global system.
It's often significantly influenced by the savings rates prevailing in other countries, especially if those high foreign savings are the result of policy distortions that can, in turn, force lower savings rates domestically.
This really underscores the deep interconnectedness of savings and investment decisions across the global economy. What one country does with its savings and consumption can have significant ripple effects elsewhere. My savings rate depends on your policies.
And the fundamental accounting identity we discussed earlier, that in the global economy as a whole, total trade surpluses must always equal total trade deficits, becomes really important here.
It must balance globally.
If one country decides to run a larger trade surplus, then by definition, some other country or group of countries must be running a larger trade deficit, or some other country's existing surplus must decrease.
This is a crucial point that is often overlooked in national-level policy debates. You can't analyze a country's trade balance in a vacuum. It's always part of a larger global picture. One country's surplus is another's deficit.
Pettis then directly challenges the rather common notion that the persistent trade deficits run by the United States are solely the result of an American spendthrift culture and a low propensity to save.
The Americans just love to shop theory.
He poses a very pointed question. Why, if that were the only factor, wouldn't the significant subsidies provided by European governments to Airbus, a major competitor to the American aircraft manufacturer Boeing, have any impact on the U.S. national savings rate?
It's a rhetorical question, of course, designed to highlight the inadequacy of purely domestic explanations for trade imbalances and to prompt listeners to consider the role of foreign government policies. If Airbus subsidies hurt Boeing, doesn't that affect U.S. savings and investment?
He then walks through a hypothetical scenario where Airbus, thanks to these government subsidies, is able to offer its airplanes at significantly lower prices than Boeing. What would likely be the economic impact on the United States in this situation?
In such a scenario, it's highly likely that more airlines around the world would choose to purchase the cheaper Airbus aircraft, leading to a decrease in sales for Boeing.
Okay, Boeing loses business.
As a result, Boeing would likely have to reduce its production levels, potentially close down some factories, and lay off workers. While the lower prices of airplanes might lead to a slight increase in consumption within the United States, as air travel becomes more affordable.
Cheaper flights.
This increase in consumption would likely be, at least partially, if not fully, offset by the decrease in consumption resulting from the higher unemployment among Boeing workers and those in related industries. The net result would likely be a decline in overall U.S. production that is larger than any potential increase in U.S. consumption.
And why would the decline in production likely outweigh any increase in consumption?
Because not all of Boeing's revenue goes directly to paying wages to its workers. There are also costs for materials, research and development, profits for shareholders, etc.
Right, wages are only part of it.
And even if it did, those workers, if they were to lose their jobs, wouldn't suddenly have zero income. They would likely receive some form of unemployment benefits or draw down on their existing savings. Furthermore, even those who see a slight decrease in travel costs might not spend every single dollar they save. They might save some of it.
So the hit to production is bigger than the boost to consumption.
Therefore, the lost production from Boeing would translate to a larger reduction in overall economic output than the potential increase in consumer spending due to slightly cheaper air travel. Pettis also points out that worker compensation often makes up a smaller share of a firm's total revenue than its total production value, further widening the gap between a decline in production and a corresponding decline in consumption.
So this example really highlights that domestic savings imbalances aren't always solely and simply caused by factors within a country's own borders, like cultural
No,
preferences.
it's often external forces.
Distortions in one country's international trade or capital position, whether through direct subsidies or other means, must have a corresponding impact somewhere else in the global economic system.
Exactly. The global balance of payments, as we've discussed, must always balance. Higher savings in one country, especially if they are being artificially driven by policy, must be accommodated by either higher investment in that country or in others, or by lower savings in other parts of the world. There are no other possibilities in the long run.
This leads us back to Ben Bernanke's well-known global savings glut hypothesis, which he put forward after the 2008 crisis.
Right, Bernanke's explanation.
His argument was that in the years leading up to the crisis, emerging market economies, particularly those in Asia and the Middle East, were running large current account surpluses.
Exporting a lot more than they imported.
And as a result, they were exporting a significant amount of capital to advanced economies, especially the United States. This influx of foreign capital, according to Bernanke, exacerbated the U.S. current account deficit and also put downward pressure on long-term interest rates in the U.S., contributing to the housing bubble.
Bernanke's hypothesis suggested that these large capital flows from surplus countries were a significant factor in the development of the imbalances that ultimately led to the 2008 financial crisis in the U.S. It was foreign savings flooding in, basically.
Now, there's another argument that you often hear in the United States, which is that if we just put up barriers to restrict imports from countries like China, that would be a straightforward way to bring back American jobs.
The protectionist argument.
But Pettis argues that the underlying premise of this idea, often referred to as the no-overlap argument, the notion that the U.S. doesn't produce anything that China sells to it, is fundamentally flawed.
It is indeed flawed. Even if the United States did not directly produce the exact same types of goods that it imports from China, a significant reduction in Chinese exports to the U.S. would not necessarily translate into a one-for-one increase in domestic U.S. production and employment.
Why not? Where would the stuff come from?
Instead, it's highly likely that those reduced imports from China would be at least partially replaced by imports from other countries, such as Mexico or Vietnam, for example. Trade just gets rerouted.
Pettis uses a simplified example involving 4 countries, China, the U.S., Mexico, and Brazil, to illustrate this point. If the U.S. decides to reduce its imports from China by $100, what's the likely chain reaction?
Okay, in this scenario, American consumers would likely start buying similar goods from Mexico instead of China, perhaps at slightly higher prices.
Okay, shift to Mexico.
This would lead to an increase in production in Mexico, but probably not by the full $100, as Mexican producers might face capacity constraints or higher input costs. The newly employed or better-paid Mexican workers would then likely increase their own consumption, leading to a rise in overall real household income and consumption within Mexico.
Mexicans spend more.
However, because the increase in Mexican production is less than $100 and consumption has risen, Mexico's overall trade surplus would increase by less than $100. In fact, it might even initially decline if Mexican businesses need to invest in new equipment or expand capacity to meet the increased U.S. demand,
They need to import machines or something.
leading to a temporary surge in Mexican imports from somewhere else, perhaps even from the U.S. or Brazil. It gets complicated quickly.
So the key takeaways from this simplified example are that the no-overlap argument is indeed too simplistic. International trade doesn't have to balance bilaterally between 2 countries.
Trade finds a way.
More importantly, it highlights that what really matters is the totality of trade intervention and the global flows of goods and capital. If one country tries to unilaterally reduce its imports from another, the targeted country might well take countermeasures. Or the trade flows might simply be rerouted through other countries, potentially negating the intended effects and even creating more distortions in the global trading system.
Exactly. It can be like squeezing a balloon.
Pettis emphasizes that if policymakers want to address trade imbalances effectively, they should probably focus on the overall surpluses and deficits, rather than just targeting specific bilateral trade relationships or individual factors.
Precisely. The interconnectedness of the global economy means that actions taken in one part of the system can have complex and sometimes unexpected consequences in other parts. A narrow focus on bilateral trade deficits can often be misleading and counterproductive.
What about a situation where a surplus country like China decides to make a large, politically motivated purchase of goods from a deficit country like the US, for example, buying a significant number of Boeing airplanes during a period of economic recession in the United States?
The buying mission scenario.
What kind of impact would that have on the overall trade balance and the US economy?
In a scenario where the U.S. is experiencing a recession with high unemployment and weak investment, a large purchase of Boeing airplanes by China would likely have a relatively limited impact on overall U.S. wage levels or the cost of capital.
Because there's slack in the economy.
Exactly. Instead, Boeing, facing increased demand, would likely hire some of the unemployed workers, leading to an increase in total U.S. employment and thus a rise in aggregate U.S. consumption.
People get jobs, they spend money.
The U.S. would export more, the Boeings, and as a result of the increased economic activity and employment, it would likely also import more goods and services. The net effect on the U.S. current account deficit, the broadest measure of the trade balance, might be relatively small, potentially even unchanged,
Exports up, imports up, washes out.
as the increase in exports is offset by an increase in imports. However, the U.S. economy as a whole would likely experience a boost in growth and a reduction in unemployment, which could be seen as a positive outcome, even if the trade deficit doesn't shrink. It helps with jobs, not necessarily the trade gap itself.
Pettis refers to these kinds of large, often politically motivated purchases as national shopping sprees. What's his overall take on their effectiveness as a tool for addressing underlying trade imbalances?
He argues that these kinds of national shopping sprees, while they might generate positive headlines and benefit specific industries in the purchasing country,
Good PR for politicians?
tend to have very little to no net impact on the overall global trade balance because they don't fundamentally alter the underlying net capital flows between countries. It's just shifting around what is traded, not the overall imbalance.
So it doesn't fix the SI problem.
Exactly. Strict market-oriented economists might even view them as potentially wealth-destroying if the purchasing decisions are driven more by political considerations than by pure economic efficiency. Buying things you don't really need just for show.
Mm-hmm.
While a specific company like Boeing might be a clear winner in the example we discussed, those gains could potentially come at the expense of other sectors within the U.S. economy. Similarly, while Airbus might lose out on that particular sale, other European businesses might benefit from the increased U.S. imports that result from the higher employment and consumption.
So if these national shopping sprees aren't very effective at fixing trade imbalances, what might be a more impactful approach? Pettis suggests the idea of reverse investment sprees. What exactly does he mean by that?
Instead of a surplus country like China buying a large amount of goods from a deficit country like the U.S., a reverse investment spree would involve China reducing its purchases of U.S. assets, such as government bonds,
Stop buying treasuries.
and instead increasing its purchases of assets in, say, Europe. In that scenario, the U.S. trade deficit and the European trade surplus would likely decline by roughly the amount of the shift in investment flows, minus any subsequent adjustments in overall capital flows. It directly tackles the capital flow imbalance.
But that's less flashy.
Exactly. Pettis notes that this kind of policy action is often less politically appealing than announcing a big purchase of airplanes, as politicians can't easily claim credit for simply reducing their country's purchases of foreign government bonds, even though such actions could potentially be more beneficial for the long-term health of their own economy and the global financial system.
Now let's turn our attention to the case of Europe. Pettis reiterates his central argument that policy distortions implemented in one country within a tightly integrated economic zone like the Eurozone will inevitably have significant and often opposite effects on other member countries.
The Eurozone is a prime example of these dynamics.
We touched on the dynamic between Germany and Spain earlier. He stresses again that simply attributing trade deficits solely to a supposedly ingrained spendthrift culture in deficit countries is not only meaningless, but also demonstrates a fundamental lack of understanding of how the global balance of payments actually works.
It's that moralizing narrative again, which he strongly refutes. It ignores the systemic pressures.
Spain, after the bursting of its massive property bubble in 2008, found itself in a really difficult position.
A terrible position.
Because it was part of the Eurozone and couldn't devalue its own currency, the primary ways it could try to regain competitiveness were either through a prolonged period of high unemployment to force down domestic costs and wages,
Internal devaluation, a very painful process.
or by the politically and economically disruptive move of leaving the euro and then devaluing its new currency. Neither option was particularly attractive.
Those were indeed the most likely and also the most painful short-term adjustment mechanisms available to Spain within the constraints of the Eurozone. A real bind.
Pettis suggests an alternative, although he acknowledges it was politically highly unlikely. A massive stimulus to domestic consumption within Germany, the Eurozone's largest and most consistently surplus economy.
Germany needed to spend more, basically.
If Germany had significantly reduced its income taxes or its value-added tax, VAT, it could have boosted domestic spending, potentially turning its large trade surplus into a deficit.
Let Germany become the engine of demand for a change.
This, in turn, would have allowed deficit countries like Spain to increase their exports to Germany, grow their economies, and have a better chance of repaying their accumulated debts.
It would have helped rebalance the whole Eurozone.
However, Germany's strong commitment to maintaining its export-led growth model and its aversion to running budget deficits made this kind of coordinated adjustment highly improbable.
Germany's deeply ingrained economic philosophy, the Schwarz and Null, or balanced budget idea, the focus on export competitiveness, effectively prevented this kind of intra-Eurozone rebalancing through demand management. It was politically toxic in Germany.
Can you walk us through the basic mechanics of the financial crisis that unfolded in Europe, particularly focusing on those negative feedback loops that Pettis describes?
Sure. When doubts began to surface in the financial markets about the ability of certain Eurozone governments, like Spain and Greece, to repay their debts,
Mark of jitters.
creditors naturally reacted by increasing the interest rates they charged on new loans and by shortening the maturities of those loans. This made the existing debt burden heavier and made government balance sheets more fragile, significantly increasing the perceived probability of default.
A debt spiral starts.
In response to these growing fears of a fiscal crisis, ordinary households in these countries became worried about potential consequences like rising inflation, currency depreciation if they were to leave the euro, or even the freezing of bank deposits.
People get scared.
This led to a phenomenon known as capital flight, where individuals and businesses started withdrawing their deposits from local banks and moving their money out of the country, which further reduced the availability of lending and exacerbated the economic slowdown.
Bank runs, essentially.
The declining credibility of the government also had a significant impact on business behavior, leading to reduced investment, business closures, and even entrepreneurs leaving the country altogether, resulting in further job losses and a reduced capacity for the government to service its existing debt.
Brain drain, investment freeze.
Rising unemployment, in turn, often led to increased social unrest, the rise of more radical labor unions, and increased labor agitation, which further weakened the prospects for economic growth and recovery.
It feeds on itself.
Exactly. This created a self-reinforcing negative feedback loop. As the perceived probability of government default increased, it forced various economic actors into behaviors, like capital flight and reduced investment, that actually weakened balance sheets and reduced economic growth, which in turn further increased the likelihood of default, a vicious cycle.
And Pettis is quite critical of the way Germany's role in this crisis was often portrayed, with some commentators praising Germany as the thrifty, responsible nation and deriding the high-consuming, supposedly irresponsible Southern European countries.
Yes, he really pushes back against that simple story.
He argues that this narrative overlooks the significant impact of Germany's own domestic policies.
He contends that the common moralizing narrative failed to recognize how German domestic policies in the years leading up to the crisis were actually a significant contributing factor to the imbalances within the Eurozone.
What policy specifically?
In the aftermath of German reunification, Germany faced high levels of unemployment and implemented policies of wage restraint and consumption constraints. The Hartz reforms are part of this
Right, the labor market reforms.
in order to boost its international competitiveness and create jobs in its export sector. While these policies might have been sensible in the 1990s when Germany itself was not running large current account surpluses, the introduction of the euro in 1999, with its fixed exchange rates, fundamentally changed the impact of these German policies in the following decade,
How so?
leading to very large and persistent German trade surpluses within the eurozone. Germany became super competitive within the fixed exchange rate system, pushing others into deficit.
And because of the euro's fixed exchange rates, countries like Spain that were losing competitiveness couldn't use currency devaluation as a tool to adjust.
Nope, that tool was gone.
This forced them to rely on much more painful adjustments through domestic wage and price changes, or ultimately through high levels of unemployment.
Exactly. The loss of the independent exchange rate as an adjustment mechanism within the eurozone was a critical factor that exacerbated the crisis and made adjustments so brutal for the periphery.
So, in the years leading up to the crisis, how exactly was Germany's large trade surplus accommodated by countries like Spain? Where did all that extra German saving end up going?
There were a few key mechanisms at play. Firstly, Spain experienced a boom in debt finance investment, particularly in infrastructure and the housing market. Think ghost airports and empty apartment blocks.
The property bubble.
This boom was largely funded by capital exports from Germany, which were looking for higher returns than they could get at home. And these capital flows kept real interest rates relatively low in Spain, potentially contributing to the asset bubbles. German money poured into Spanish property.
Okay, German capital-funded Spanish investment. What else?
Secondly, Spanish savings rates actually dropped during this period. As domestic consumption rose faster than GDP, people were spending more.
Hmm.
This increase in consumption was also facilitated by capital inflows from Germany and rising levels of consumer debt in Spain, encouraged by the artificially low interest rates set by the European Central Bank, ECB,
Low rates set for Germany's needs.
which were largely geared towards the needs of the stronger German economy, but were way too low for booming Spain.
So cheap money-fueled consumption, too.
Thirdly, Pettis points out that Spain could have, in theory, tried to refuse to absorb these German savings by implementing tight fiscal policies, cutting government spending and raising taxes, which would have likely led to higher unemployment and lower growth even before the crisis.
But politically difficult.
Very. And as a member of the Eurozone, Spain had very limited control over its own interest rates, making this a difficult policy to implement effectively until the debt crisis itself forced interest rates sharply higher.
And then, when the housing bubble burst in Spain and the accumulated debt levels became unsustainable, interest rates in Spain soared.
The party stopped abruptly.
This led to a sharp collapse in both real estate investment and consumer spending. Effectively, Spain was forced to stop importing German savings, and the consequence of that was a dramatic surge in unemployment as the Spanish economy contracted.
That's the core of the crisis dynamic within the Eurozone. As long as Germany continued to pursue policies that generated large trade surpluses, and as long as other Eurozone countries continued to absorb those surpluses through borrowing and increased consumption or investment, the imbalances could persist.
It seemed stable, but wasn't.
But when the flow of credit dried up, the underlying misalignments were exposed, leading to painful adjustments. And as Pettis argues, unless Germany fundamentally reverses the policies that create its persistent surpluses,
Which they haven't really done.
countries like Spain will continue to face high unemployment and slow growth until significant wage adjustments occur, or they resort to protectionist trade interventions. Both of these outcomes would, in turn, negatively impact Germany by reducing its export markets and forcing its savings back into its own economy, requiring either a surge in German domestic investment, which hasn't materialized, or a significant drop in German savings, likely through increased unemployment in Germany itself. The imbalance has to resolve somehow.
Moving on to the concept of foreign capital go home. Pettis uses a hypothetical scenario where the People's Bank of China, PBOC, China's central bank, sells $100 billion of U.S. government bonds to illustrate the often misunderstood complexities of international capital flows.
Right, the what if China dumps treasuries question.
Can you walk us through the different possible outcomes he outlines?
Sure. Pettis presents three main scenarios following the PBOC's sale of $100 billion in U.S. treasuries. In the first scenario, the PBOC simply uses the proceeds from selling those U.S. bonds to buy other U.S. dollar-denominated assets, such as corporate bonds or other types of securities.
Just shuffling dollars around within the U.S. market.
Exactly. In this case, the impact on the overall U.S. Treasury market would likely be minimal, and there would be no direct impact on the trade balance between the U.S. and China or any other country. We might see a very slight increase in the yield on U.S. Treasuries and a correspondingly slight decrease in the credit spread, the difference in yield, on riskier corporate bonds, perhaps reflecting a minor shift in market sentiment towards risk, but not a major event.
Okay, scenario one. Not much happens. Scenario two.
In the second scenario, if China decides to use the $100 billion to buy an equivalent amount of euro-denominated bonds issued by European governments or corporations,
Selling dollars, buying euros.
the impact on the U.S. depends on how European investors and institutions respond to this inflow of capital. In one possible European response, they might simply act as intermediaries and use the $100 billion inflow to buy $100 billion of U.S. dollar-denominated assets themselves.
So Europe recycles the dollars back to the U.S.
Essentially, yes. In this case, the net effect on the U.S. Treasury market and global trade balances would again be close to zero, with the only change being that European entities now hold the U.S. bonds that China used to own. The hot potato just gets passed.
What's the other European response?
In another possible European response, they might use the inflow of $100 billion to reduce their own issuance of new bonds or to increase government spending without issuing more debt. In this case, the overall demand for U.S. Treasury bonds would fall slightly, and the euro might strengthen relative to the U.S. dollar.
So some real impact here.
Potentially. This could lead to a marginal reduction in the U.S. trade deficit and China's trade surplus, but it would also likely reduce the trade surplus of the eurozone. It shifts the imbalances around.
Okay. And scenario three.
In the third, and perhaps most direct scenario, China might decide to intervene less in the currency market and allow the renminbi to rise in value against the U.S. dollar.
Let the currency move.
If the renminbi appreciates, Chinese exports would become relatively more expensive for American consumers, and U.S. exports would become relatively cheaper for Chinese consumers. This could lead to a direct decline in China's trade surplus with the U.S. and a corresponding decline in the U.S. trade deficit with China, potentially by around $100 billion.
The most direct link to trade?
The net impact on the overall U.S. economy in this case would depend on how American consumers and businesses responded to the change in relative prices, whether they increased their consumption of other goods or simply reduced their borrowing.
So the accumulation of U.S. bonds by China and the extensive lending by German banks to peripheral European countries in the lead up to the crisis weren't necessarily disinterested acts of financial prudence or generosity.
No, Pettis emphasizes that these capital flows were largely the automatic and in many ways necessary consequences of the underlying economic policies being pursued by the surplus countries, China and Germany.
Here's just the flip side of their surpluses.
These policies, while perhaps aimed at achieving domestic goals like export-led growth, may have inadvertently created or exacerbated imbalances that were ultimately harmful to the deficit countries.
He uses Germany as a prime example again. Its remarkable export success, largely driven by policies that suppressed domestic consumption and kept wages relatively low,
The German model.
inherently required other countries, particularly those in peripheral Europe, to run large and offsetting current account deficits. And the very low interest rates that prevailed across the Eurozone in the years before the crisis, which were largely influenced by the economic conditions and monetary policy preferences of Germany, made it much easier for these deficit countries to borrow and finance those deficits.
Exactly. The flow of capital from German banks to finance borrowing in peripheral European countries was a necessary part of the overall dynamic that allowed Germany to maintain its large export surpluses and simultaneously contributed to the growing debt problems in the deficit countries.
Two sides of the same euro coin.
Pettis argues that, with hindsight, it's clear that there was a degree of what could be called foolish behavior on both sides of these capital flows. Lenders were eager, borrowers were eager.
Given this, Pettis finds it somewhat illogical for Germany to then insist on a strong moral obligation for these peripheral European countries to prevent any erosion of the value of German banks' loan portfolios when the crisis hit.
Yeah, the payback every cent argument ignores how the loans happened.
He suggests that countries should primarily act in their own national economic interests, and Germany's initial lending was, after all, aimed at supporting its own job creation and economic growth through exports.
His point is that, while there were undoubtedly issues of fiscal responsibility in some of the deficit countries, the surplus countries also played a role in creating the conditions that led to the crisis, and therefore the burden of adjustment shouldn't fall solely on the borrowers. It takes two to tango.
He simplifies the dynamic by referring to the surplus countries collectively as Germany and the deficit countries as Spain to illustrate how their respective policies ensured the persistence of these large macroeconomic imbalances within the Eurozone.
A useful shorthand.
And as long as Germany continued to run surpluses and Spain continued to run deficits, there had to be a net flow of capital from Germany to Spain to finance those deficits, whether in the form of direct investment or lending. After all, as we discussed earlier, the capital account and the current account of the balance of payments must always balance out.
This is a fundamental principle that underscores the interconnectedness of trade and finance in the global economy. Capital flows are the mirror image of trade flows.
Pettis then briefly looks back at some historical mechanisms that were supposed to automatically adjust these kinds of international payment imbalances. He mentions David Hume's price-specie flow mechanism from the 18th century,
Hume, back in 1752.
where the movement of gold between countries was thought to automatically balance payments, causing price deflation in deficit countries, making their exports more competitive and imports less attractive, and inflation in surplus countries having the opposite effect.
Gold flows out, prices fall. Gold flows in, prices rise. An automatic adjustment.
But he also notes the obvious limitations of this system, such as the finite gold and silver holdings of deficit countries. He points out that Habsburg Spain's massive silver discoveries in the Americas seemed to allow it to run persistent deficits for a while.
They thought they had infinite money.
But ultimately, its constant wars drained its silver reserves.
These historical examples illustrate the long-standing challenge of managing international payments and the various attempts throughout history to find stable adjustment mechanisms.
He also touches on Hobson's earlier view about the role of capital exports to colonies during the age of imperialism, suggesting that the excess domestic savings in the imperialist centers flowed to the colonies, ensuring large and persistent trade surpluses for the centers.
This represents another historical way in which imbalances were managed, albeit one with significant ethical and political implications, forcing colonies to absorb capital and run deficits.
But in today's globalized world, there's no such need or automatic adjustment mechanism for persistent current account imbalances like the price-specie flow or the imperialistic relationship.
Not really. The Bretton Woods system tried, but it collapsed.
So if a situation arises where a large, powerful economy like Germany consistently runs very large trade surpluses with another significant economy like Spain, what are the likely long-term outcomes, according to Pettis?
Pettis outlines three main possible long-term outcomes in such a scenario. The first is that Spain could theoretically continue to borrow indefinitely from Germany. Selling off national assets could be seen as a subset of this.
Borrow forever.
While this might seem absurd on the surface, its feasibility actually depends on the size of the surplus and the surplus country relative to the deficit country's overall economic growth rate. However, it becomes clearly unsustainable if the surplus country is very large or runs very large surpluses relative to the deficit country's economy. Eventually, you run out of things to sell, or the debt becomes too big.
Okay, what's the second outcome?
The second possible outcome is that Spain eventually defaults on its debts to Germany. This would be a highly disorderly outcome for both countries, potentially leading to significant financial contagion and problems in the banking sector. Very messy.
And the third?
The third possibility is that Germany fundamentally reverses the policies that are creating its large trade surplus, primarily by boosting domestic consumption. Let German wages rise, cut taxes, encourage spending.
Rebalance internally.
However, this would likely be painful for Germany in the short to medium term, potentially leading to slower economic growth, higher unemployment, as the export sector might shrink, and rising government debt as tax revenues might fall and social safety net spending might increase. It means unwinding their successful but distorting growth model.
In the chapter aptly titled The Exorbitant Burden, Pettis revisits the often discussed nightmare scenario of foreign countries, particularly China, suddenly initiating a massive boycott of U.S. government bonds.
The big fear.
He argues that this is actually quite unlikely, primarily because China's accumulation of these bonds is so deeply intertwined with its export-oriented growth model and its need to manage its currency. It's not really a discretionary choice for them, in his view.
Their surplus forces them to buy foreign assets, and U.S. bonds are the biggest, most liquid market.
He even mentions Hillary Clinton's somewhat pleading 2009 request to China to continue buying U.S. treasuries, highlighting the perceived importance of this relationship.
That anecdote underscores the delicate financial interdependence that exists between major economies like the U.S. and China. It looked like the U.S. needed China to keep buying.
The conventional wisdom often holds that the US dollar's unique status as the world's primary reserve currency grants the United States two main privileges.
The exorbitant privilege, as de Gaulle's finance minister called it.
First, it allows the U.S. to consume and borrow beyond its immediate means because there's always global demand for dollars and dollar-denominated assets. And second, the consistent foreign demand for U.S. Treasury bonds helps to keep U.S. interest rates lower than they might otherwise be.
Those are the standard arguments.
But Pettis challenges both of these widely held claims.
He flips the script a bit.
Yeah.
He argues that while the dollar's reserve status may indeed facilitate a higher level of U.S. consumption than would otherwise be sustainable.
So he agrees with that part.
Yes, but he says it does so largely because foreign central banks, in their efforts to manage their own currencies and promote export-led growth, or due to financial repression, often force down consumption within their own economies, increase their national savings rates, and then export those savings, often in the form of purchases of U.S. dollar-denominated assets like Treasury bonds.
So the U.S. privilege is actually the flip side of other countries suppressing their own demand.
Exactly. So in a sense, the U.S. privilege is a byproduct of policy choices made by its trading partners that often come at a cost to their own domestic economies. It's less a privilege for the U.S. and more of a burden imposed by others, forcing the U.S. to absorb their excess savings.
That's a really different perspective, and this somewhat uncomfortable reality seems to be increasingly recognized globally, perhaps even more so outside the United States itself.
There are signs of that. Pettis points to the example of several Latin American and Asian central banks starting to diversify their foreign exchange reserves into Japanese government bonds in 2011 as an indication of this shifting perspective.
And Japan.
Japan, notably, has historically resisted the idea of an exorbitant privilege for its own currency, often intervening in the foreign exchange markets to weaken the yen, fearing the negative impact of large foreign bond purchases on its export competitiveness.
They didn't want the strong currency that comes with reserve status.
Similarly, China, despite its desire for the renminbi to achieve reserve currency status, has also restricted foreign purchases of its own government bonds. These actions suggest that the status of having your currency as the primary global reserve might not be an unalloyed blessing, and that many countries actively manage their currencies in bond markets to avoid some of the potential downsides.
Consuming beyond your means, facilitated by others, isn't necessarily a good thing.
No. Pettis argues it can require the reserve currency country to choose between rising unemployment, if it doesn't absorb the foreign savings, or rising debt, if it does absorb them through government deficits or private borrowing. It's an exorbitant burden, not just a privilege.
Okay, what about the second claim? That foreign demand for U.S. treasuries automatically leads to lower U.S. interest rates.
He challenges this, too. He argues that foreigners are primarily funding current account deficits, the gap between what the U.S. buys from the rest of the world and what it sells, not necessarily fiscal deficits, the gap between what the U.S. government spends and what it collects in taxes.
They fund the trade gap, not the budget gap directly.
Oh, and that these capital flows happen somewhat automatically as a counterpart to the trade imbalances. He suggests that to maintain full employment in the U.S., the supply of U.S. dollar-denominated assets, including Treasury bonds, would likely need to increase in line with increased foreign demand, so interest rates wouldn't necessarily be pushed downwards.
Supply rises to meet demand, so interest rate doesn't fall.
That's the idea. He even proposes a counterintuitive scenario where increased foreign purchases of U.S. debt might paradoxically lead to higher U.S. interest rates if a larger fiscal deficit were required to offset the current account deficit and maintain full employment. If the trade deficit gets bigger because foreigners are pushing capital in, the U.S. might need a bigger budget deficit to keep the economy going, meaning more bond supply, potentially pushing rates up.
Wow, that's completely counter to the usual story.
His key point is that the relationship between foreign capital inflows and U.S. interest rates is far more complex and less direct than the simple supply and demand narrative often suggests. It depends on the policy response within the U.S.
He further argues that a rising current account deficit often leads to lower tax receipts due to weaker domestic production and potentially higher fiscal expenditures, for example, on unemployment benefits.
Weaker economy means less tax revenue.
Meaning that foreign purchases of U.S. assets might actually increase the supply of U.S. government bonds needed to finance the larger fiscal deficit.
So the foreign buying itself might necessitate more U.S. borrowing.
He even jokes that if the U.S. wanted to encourage more foreign central banks to buy its treasury bonds, the best way to do it would be to engineer an even larger current account deficit.
This is a somewhat provocative way of highlighting the mechanistic link between current account deficits and the inflow of foreign capital. More imports mean foreigners earn more dollars they need to invest back.
Pettis then outlines three conditions under which net foreign capital inflows might genuinely improve the long-term growth prospects of the recipient country. When is foreign money actually helpful?
Okay, first, if the country has high potential for productive investment but insufficient domestic savings to fund it, as might have been the case in the 19th century U.S. building its railroads.
Investment opportunities exceed local savings.
Second, if the inflows are primarily in the form of long-term, stable equity investment that also brings valuable expertise and technology, think foreign direct investment, FDI, not just hot money flows.
Patient capital with know-how.
And third, if the recipient country has strong institutions and governance in place to ensure that the capital is allocated efficiently and effectively, not wasted on white elephants or corruption.
Good governance matters.
He concludes by reiterating that persistent current account deficits are not sustainable in the long run, and that the history of reserve currencies is one of eventual instability and decline. Sterling lost its status, the dollar under Bretton Woods collapsed. It's not permanent.
Finally, in this chapter, Pettis discusses Zhu Xiaoshuan's 2009 proposal for a new super sovereign reserve currency, the SDR, special drawing rights, issued by the International Monetary Fund, IMF.
The head of China's central bank at the time.
Drawing a parallel to John Maynard Keynes's Bancor idea from the Bretton Woods era.
Right, Keynes wanted a neutral global currency, not a national one like the dollar.
While some in the U.S. interpreted Zhu's essay as a direct attack on the dominance of the U.S. dollar, Pettis sees it more as a reflection of the inherent weaknesses and potential instability of a global financial system that relies so heavily on credit-based national currencies as its primary reserve assets.
He thinks Zhu was pointing out the systemic flaws, not just attacking the U.S. The system itself is unstable when based on one country's currency and deficits.
He argues that the reason SDRs haven't replaced the dollar isn't primarily due to technical constraints or U.S. power, but rather due to fundamental trade constraints.
How so?
If countries were to hold more of their reserves in SDRs, which are a basket of currencies, it would necessitate a broader distribution of current account deficits across more countries, including those whose currencies are in the SDR basket. More countries would be forced to run deficits to supply the world with SDR-linked reserves.
So the imbalance problem just gets spread around, not solved.
He also points out that liquidity and relatively open capital accounts are key features of a successful reserve currency, something the U.S. provides through its persistent trade deficits and generally open capital flows.
The U.S. market is huge, deep, and relatively easy to get money in and out of.
He raises important questions about how the IMF would create and allocate SDR reserves and prevent the process from becoming overly politicized, especially given that the U.S. Federal Reserve's primary mandate is domestic economic stability, not global liquidity provision. Who decides who gets SDRs and how many?
Zhu's proposal sparked a significant debate about the future of the international monetary system and highlighted the inherent tensions in a system where a national currency also serves as the primary global reserve. The practical challenges of implementing a truly super-sovereign reserve currency are indeed substantial.
So finally, we arrive at the big question. When will the global crisis end? Pettis begins this concluding chapter by reiterating the 10 key takeaways from his analysis in The Great Rebalancing, summarizing his core arguments about trade, savings, investment, capital flows, and the role of the U.S. dollar, and emphasizing their crucial implications for economic policy.
Bringing it all together.
His fundamental argument is that the global financial crisis that began in 2008 will not truly end until the underlying macroeconomic imbalances in trade, capital flows, and balance sheets are either fully worked out or reduced to levels that are sustainable in the long run.
The persistence of these deep-seated imbalances is the key reason why the global economy has struggled to achieve a strong and sustained recovery since the initial shock of the crisis. We haven't fixed the root causes.
Looking back to 2008, Pettis notes that his own prediction at the time was that the crisis would spread globally, that the United States would likely experience a relatively painful but ultimately earlier recovery due to its more flexible economic and political institutions.
The U.S. can adjust, albeit painfully.
And that China, with its deeply entrenched imbalances and less flexible political mechanisms, would likely be the last major economy to fully adjust.
China's model was harder to change.
He acknowledges that China's rapid rebound in growth immediately after the crisis, fueled by a massive surge in bank-financed investment, initially seemed to contradict this prediction.
China looked like it dodged the bullet with that huge stimulus.
However, Pettis argues that this investment-led growth spurt in China after 2008 was not a sustainable solution and, in fact, likely exacerbated some of the underlying imbalances.
It just kicked the can down the road and arguably made the internal debt problem worse.
His critique of those who were optimistic about China's seemingly unscathed recovery was that China's fundamental growth model still relied heavily on exporting its excess savings to the rest of the world.
Still running huge surpluses.
He argues that only a significant shift towards importing capital and exporting demand, i.e., running a trade deficit, would genuinely contribute to global rebalancing and a more sustainable global economic order. China needs to become a net importer of savings.
Pettis emphasizes the crucial interdependence of the necessary adjustments. The deleveraging process that U.S. and European households and financial institutions have been undergoing since the crisis must ultimately be matched by an equivalent adjustment in China's massive savings investment gap. The world has to balance.
He outlines a more benign scenario for a global rebalancing where several key shifts occur simultaneously. What would that look like?
Okay, the ideal path would involve household income in the United States rising relative to overall GDP, leading to increased consumption and maybe lower savings.
U.S. households get a bigger slice.
European countries, particularly Germany, consuming more relative to their GDP, reducing their large trade surpluses.
Europe, especially Germany, spends more.
And China seeing a significant increase in household income as a share of its GDP, accompanied by a corresponding fall in the share of GDP devoted to investment.
China consumes more, invests less. A coordinated shift.
This kind of coordinated rebalancing would represent a much more stable and sustainable path for the global economy. But it requires everyone to move together.
Pettis also discusses the potential consequences if a large surplus country like Germany fails to adjust its policies.
If Germany keeps running big surpluses,
He suggests that it will likely lead to slow growth within Germany itself as its export markets remain weak, and also to continued problems for its banking sector, which holds significant claims against the struggling deficit countries.
German banks are exposed to Spanish, Italian, Greek debt.
He draws a parallel between Germany's recycling of its surpluses through its banking system and China's recycling of its surpluses through its central bank, both of which can mask underlying risks.
Similar mechanism, different institutions.
He points out that for peripheral European countries to repay their obligations, they ultimately need to run trade surpluses, which would necessarily imply a deterioration in Germany's trade balance.
If Spain exports more to Germany, Germany's surplus must shrink.
In the absence of a boost in German domestic consumption, Germany will eventually face the choice of either accepting slower growth and potential bank losses or writing off some of its claims against deficit countries.
Tough choices. Stagnant growth or debt forgiveness.
He then uses Japan's experience after its own asset bubble burst in the early 1990s as a cautionary tale of how not to manage a major economic rebalancing.
Japan's cautionary tale.
Japan, he argues, largely hid its financial sector losses, kept capital costs artificially low, and allowed the government to absorb much of the bad debt, leading to a massive increase in government debt, but also hindering a more fundamental restructuring of the economy.
The zombie bank problem and huge government debt.
He notes that some of the proposed solutions for Japan's ongoing economic stagnation, such as higher consumption taxes coupled with repressed income growth, actually risk raising Japan's savings rate further and thus hurting global demand.
Policies that make the problem worse globally by increasing savings. Japan's experience underscores the potential for well-intentioned but ultimately flawed policy responses to prolong economic stagnation and make future adjustments even more difficult.
Pettis concludes this chapter on a somewhat sobering note, stating that the world will eventually rebalance, one way or another.
It has to. Imbalances can't grow forever.
But that there are clearly better and worse ways for this to happen. He emphasizes that large and persistent trade surpluses and deficits are ultimately unsustainable, and that the primary policy goal should be to navigate the rebalancing process in the least painful way possible, which will likely require a significant degree of international cooperation and understanding.
Cooperation is key, but hard to achieve.
He expresses uncertainty about whether current policies around the world are actually leading us down this less painful path. He ends with a rather apt quote from Lewis Carroll. "It takes all the running you can do to keep in the same place, highlighting the constant effort required to maintain stability in a dynamic and interconnected global economy."
That quote serves as a powerful reminder of the ongoing challenges and the need for constant vigilance and adaptation in the face of global economic forces. It feels like we're always running just to stand still sometimes.
And finally, the book includes an appendix titled, Does Income Inequality Lead to Unemployment? Pettis frames the discussion of rising income inequality largely as another lens through which to view the problem of excess savings in the global economy.
Inequality and excess savings are linked, he argues.
He points out that periods of rising income inequality have often coincided with the buildup of global imbalances and financial crises, such as in the 1870s, the 1930s, and the 1970s.
He argues that significant increases in income inequality tend to force up the overall savings rate in an economy,
Why?
as wealthier individuals typically save a much larger fraction of their income than those with lower incomes. If more income goes to the rich, more gets saved overall.
Okay.
This can then lead to an imbalance between the total supply of goods and services and the total demand for them, which can be temporarily masked by a surge in credit-financed consumption or can ultimately manifest as rising unemployment. Too much saving, not enough spending.
He further explains that rising income inequality has the direct effect of reducing the total demand in an economy by forcing down the consumption share of GDP,
Less money for people who spend most of it.
and also potentially reducing productive investment if there isn't sufficient demand to justify it. He quotes Mariner Eccles, the chairman of the Federal Reserve during the Great Depression, who famously spoke about the lack of effective demand as a key driver of economic downturns.
Eccles saw that lack of purchasing power was the problem. Pettis notes that a declining household share of GDP, as seen in countries like Germany and China due to wage restraint and financial repression, has a very similar impact to rising income inequality in terms of its effect on overall savings and consumption patterns.
So whether it's inequality within the household sector or the whole household sector shrinking relative to corporations or the state.
Both phenomena lead to a squeezing of the household sector's share of the economic pie, which has significant macroeconomic consequences for savings and demand.
He points out that even if the savings rates of individual households remain relatively steady, if the overall share of income going to the household sector declines,
Their slice gets smaller.
then the total level of savings in the economy as a whole will tend to rise as a share of GDP, simply because a larger portion of the total income is now accruing to those with a higher propensity to save, like corporations or the very wealthy.
Exactly.
Yeah.
This wealth transfer, whether from the poor to the rich or from households to the state and corporations, must have a significant impact on the overall levels of saving and consumption in the economy. You can't just shift income around without macroeconomic effects.
Pettis then discusses the two primary ways in which the balance between total savings and total investment in an economy can be maintained. Either investment must rise to match the increased savings,
S must equal I.
or the level of savings must somehow be counteracted by other economic events that cause an equivalent reduction in overall saving. He then explores the various ways in which investment might increase,
Like what?
including productive investment that leads to future growth, unproductive investment like the buildup of unwanted inventories, and other forms of unproductive investment in assets that don't generate real economic value, like maybe some types of real estate speculation.
Productive investment is good. Unproductive, not so much. He argues that in many rich countries today, a lack of sufficient savings is not the primary constraint on growth, making a large increase in productive investment to absorb increased savings less likely. We have savings, we lack demand or good projects.
Okay, what about the other way savings somehow don't rise despite the income shift?
He considers the ways in which overall savings might not actually rise despite a wealth transfer. One possibility is if the wealthy or the state consume just as high a proportion of their increased income as ordinary households did of their lower income,
Do billionaires spend as much of their extra dollar as middle-class families?
which he deems unlikely. Another is if ordinary households respond to their lower income or reduced wealth by actually increasing their rate of consumption and reducing their rate of saving, perhaps by taking on more debt.
Borrowing to keep up consumption.
This, he notes, is what happened in the lead-up to the 2008 crisis, with credit finance consumption fueled by perceived wealth from asset bubbles. But this is clearly an unsustainable dynamic. You can't borrow forever.
Right. What's the final possibility?
The final possibility he considers is a rise in unemployment, which, while painful, is a sustainable mechanism for balancing increased savings in one part of the economy with decreased overall savings as more people lose their jobs and reduce their consumption.
Unemployment forces savings down because people have less income.
Exactly. Rising unemployment effectively reduces the overall savings rate by lowering incomes and forcing some people to draw down on their existing savings to cover living expenses. It's a brutal balancing act.
Pettis then revisits the cases of Germany and Spain to illustrate these dynamics. Wage restraint in Germany led to an increased German savings rate.
German corporations saved more, households saved less maybe, but overall savings went up.
Because this wasn't balanced by a corresponding increase in German domestic investment or consumption, these excess savings were exported to Spain, fueling unsustainable debt and ultimately leading to the unemployment crisis there.
Germany's excess savings caused Spain's debt bubble and bust.
He concludes by reiterating that the unsustainable outcomes of debt-backed unproductive investment and soaring credit finance consumption have their limits, as dramatically demonstrated by the 2007-08 crisis.
Those paths lead to crashes.
The remaining balancing mechanism in many cases is a rise in unemployment, as tragically seen in Spain. He suggests that if Spain were to leave the euro and devalue, its own unemployment might fall, but this could come at the cost of rising unemployment in Germany as its exports become more expensive.
The pain just shifts, potentially. This highlights the difficult trade-offs and interconnectedness within the global and regional economies. Someone has to adjust.
Finally, Pettis suggests three potentially sustainable solutions to a global demand crisis stemming from excess savings. What are they?
First, a significant surge in productive investment, which might require more active state involvement, perhaps in green infrastructure or technology.
Invest our way out productively.
Second, a reduction in the income share going to the state and the wealthy to boost household income and consumption, basically tackling inequality or the low household share of GDP.
Redistribute income towards spenders.
Or third, absent these more proactive measures, accepting the painful reality of prolonged high unemployment as the de facto balancing mechanism.
Unemployment becomes the default solution if we do nothing else. These represent the fundamental choices and challenges facing economies grappling with imbalances between savings and investment. So, to bring it all together, this deep dive into Michael Pettis's work reveals that the intricate web of global trade, savings, investment, and capital flows is far more complex and interconnected than simple explanations often suggest.
It's definitely not simple.
Policy distortions in one country can have far-reaching and often counterintuitive consequences in others. The global balance of payments is a delicate mechanism, and simplistic narratives based on cultural stereotypes or isolated national actions are frequently misleading when trying to understand major economic events like the 2008 financial crisis.
What's truly fascinating and also quite sobering is to realize just how these seemingly abstract economic mechanisms that we've been discussing have very real-world consequences, shaping not only the stability of the global financial system, but also the individual economic opportunities and livelihoods of people across the entire planet. These aren't just numbers. They affect real lives.
Now that you've taken this pretty comprehensive deep dive with us into the intricacies of global trade imbalances and their connection to major economic crises, we hope you have a much deeper understanding of the forces at play.
Hopefully it sheds some light.
Consider the implications of these detailed mechanisms for the future stability of the global economy. What new perspectives might you now bring to your understanding of global economic news and policy debates? What further questions does this exploration raise for you? We certainly encourage you to continue exploring these vital and often surprising topics.